Inflation just came in at 3.8% for April 2026, the highest in almost 3 years, driven by war-driven energy costs. The Fed is expected to cut rates toward 3% within the next year. When the rate your savings earn falls below the rate prices are rising, there's a name for that, called financial repression. The last time the US ran this playbook, it lasted 35 years and cost savers trillions in real purchasing power. Right now, your high-yield saving account is at 4.5%. CPI is at 3.8%. Your real return is less than 1%. And the Fed is about to move it lower. That gap is not an accident. It's what financial repression looks like in its early stages. I'm Amy, and this is the kind of thing that doesn't make headlines, which is exactly why I'm covering it. In this video, I will explain what financial repression is, how the US used it for 35 years after World War II to erase a debt crisis, and the 3 moves that protected household wealth then and can protect it now. Stay to the end. I'll show you the household math on what a 2-point real rate gap costs over 10 years. The number is bigger than you think. US debt is at 121% of GDP, the highest since 1946. The Iran war is costing $1 billion a day. Interest payments on federal debt exceeded the entire defense budget in 2025 for the first time ever. When a government is this deep in debt, there are only 2 exits: dramatic spending cuts, which rarely happen, or letting inflation run above the rate your savings earn. That second path doesn't require a vote, and history shows it's the first one governments reach for. Most investors keep their safe money in a high-yield savings account, money market, or bond allocation. That worked fine in the 2010s, when real yields were slightly positive. But then 2020 happened. This chart shows the 10-year TIPS real yield, whether your safe assets are actually keeping up with inflation. From 2003 to 2019, this stayed above 0. Then the Fed cut to 0, quantitative easing pinned yields, inflation surged, and this line collapsed to -1%. Your high-yield saving account was earning 0.6%. CPI was running at 9%. That was financial repression. You felt it. You just didn't have the name for it. The Fed hiked rates in 2022 and rescued real yields. Today, the real rate is back at 1.9%. But with 3.8% CPI and a Fed heading toward 3%, the rescue is temporary. We are watching the conditions for the next wave assemble. Call it the safe rate illusion. Your high-yield saving account at 4.5% looks healthy. But subtract 3.8% inflation and your real return is 0.7% and falling. If the Fed cuts to 3% while war-driven energy keeps inflation above 3%, real returns go negative again. The historical proof for where this leads is unambiguous. After World War II, the US ran negative real interest rates for most of 35 years. Reinhart and Sbrancia's IMF research showed this mechanism liquidated 3 to 4% of GDP in federal debt every single year. Real returns on US government bonds, the safe allocation, averaged negative 0.3% per year from 1945 to 1980. Federal debt fell from 119% of GDP in 1946 to 31% in 1974, not through fiscal discipline, through a sustained compression of what savers earned in real terms. No vote required, no line item on your tax return. The government's incentive today is even stronger. Debt is higher now than it was in 1946, and a war is actively adding to it. 3 moves from the historical playbook. First, read the signal. Real rate equals your savings yield minus CPI. Below 0 is active repression. Below 1% is the warning zone. You're at 0.7% today. Watch the direction, not just the level. Second, audit your long-duration bond exposure. Long bonds lock in a nominal yield while inflation erodes every payment. TIPS funds and short-duration bonds adjust. In a sustained repression cycle, that structural difference determines whether you hold real value or quietly lose it. Third, understand the asset rotation. When real rates rose in 2022, the Nasdaq fell 33%. Value indices fell 7 to 10%. Across the post-World War II repression era, real assets and dividend-paying stocks consistently outperform nominal bonds over any 10-year window. The data points in one direction. Here is the calculator moment. $100,000 in a high-yield saving account at 4.5%, with inflation averaging 2 points above that rate, the mild version of repression. Over 10 years, your real purchasing power is approximately $83,600, not $100,000. And the post-World War II average gap was 3 to 4 points above the savings rate. At that pace, the 10-year real loss on a $100,000 balance is closer to $28,000. The conditions are assembling: 121% debt to GDP, a war adding $1 billion a day, inflation back at 3.8%, and a Fed moving toward rate cuts. The first repression wave ran 2020 to 2022. The second is being loaded right now. 3 action points. 1. Calculate your real rate. Savings yield minus CPI. If it's below 1%, you're in the warning zone. 2. Shift long-duration bond exposure in your 401k toward TIPS funds or short-duration alternatives before the Fed cuts further. 3. Tilt your equity mix toward value, dividends, and real assets. The 35-year post-World War II data is consistent on this. Subscribe to stay ahead of the data.